Hello and welcome to Look Investor. So let's talk a little bit on stagflation today. Before we get to stagflation, first let's quickly go over our trades. So I've talked about my next buying target would be when nasdaq is around 12k, and it got there around 10 o'clock in the morning. So I bought in some more TQQQ at 33.3 bucks, and that's the only thing that I've done on Friday. So back to stagflation. By textbook definition, stagflation is when you have inflation numbers going high and you have the economy slowing down and you have a high unemployment rate. So in comparison to recession, which is decline in GDP and high in unemployment rate, stagflation also have the high inflation on top. So it's sort of like recession on steroid, and it is the worst thing that can happen to an economy. So let's take a look at some data on inflation, economy, and unemployment to determine if we're heading into a stagflation or not. So first, let's go over the inflation data. As you know, the CPI data was 8.5% in March, and I was expecting it to come down for a little bit for April data, since food and energy has come down for quite a bit in comparison to March data. But the inflation data that the Fed pay attention to is the PCE, and the PCE index excludes food and energy as they think those two areas are very volatile. So for PCE, it increased 5.2% as of March in comparison to a year ago. And the average median for the past 10 years for PCE is around 2%. So at 5.2%, we're still a bit high over the median. So first of all, what causes the price to rise? And it is as simple as supply and demand. And currently it is the supply side that is having an issue. As you have always read on the news, there is a supply chain shortage pretty much on everything. So if the demand of goods remain the same with the supply getting lower, that will create the price increase. So in the Fed's point of view on supply chain issue, they can do nothing about it because they don't control the supply chain. As you know, most of this stuff are made in China, and beforehand there was the container shortage, and then there were periodic lockdown in China, which causes the shortage into manufacturing goods. As you know, China is the world factory, and currently, you know, Shanghai and Beijing, they're also in some sort of a lockdown, and there are manufacturing in those areas. So we might see another wave of supply shortage in the coming months. So on the supply side, they can't do anything about it, so they can only focus on the demand side. And in order to decrease demand, what they can do is to increase the rate height. With high interest rate, it tends to slow down the demand for goods for the economy. So that is their strategy to combat the inflation. So since PCE data is excluding food and energy, one sector that plays a big part in the PCE index is the used and new car sales. As you know, since the end of last year and at the beginning of this year, the used car sales pricing are pushing higher. As you know, there were a shortage of new cars, so people have to wait 6 to 9 months for a new car. And some of them, if they need it right away, they will have to look for the second-hand market. So for example, I bought a car in October 2020, and if I were to sell my car 2 months ago, I would have made some money, which is sort of ridiculous in some sense. But anyways, the used car prices have been coming down, and although it is still 40% higher from year to year, it has been dropping from January from record high. And the Fed also mentioned we might have seen the peak of inflation in March. So in the coming months, and I've also talked about this in some of my previous video, that we have seen the peak of inflation in March data, and in the coming couple of months, we'll see the CPI coming down. But I don't think it will come down from 5.2% to 2% median right away. It might come down to 3 to 4%, and it might stay there for a little bit. But in a short medium term, let's say 3 to 4 months, I would expect the inflation percent to come down a little bit. As for oil prices, if Europe has decided to sanction and not buy any Russian oil, that could snore the oil price up. And currently, as mentioned before, China is in lockdown, so their demand for oil is less at the moment. And if their lockdown is over, that could push the demand higher, and which will cause the oil price to raise again. So as much as I see oil prices will come back down in the next couple of months, those two scenarios that I have just mentioned may cause the table to turn around. So in conclusion, for inflation, I do think we have seen the peak of inflation in March. As you can see, the used car sales, the energy, the food has been coming down. So in the next couple of months, the CPI should come down for a little bit, but we will be in a still relatively high inflation environment, but just not as high as currently right now. So that is my take on inflation. So besides GDP, one of the indicators that people would like to use is the Purchasing Managers Index, the PMI. And as you can see, the PMI has been coming down since October and November 2021. And the decline can be due to the decrease of the consumer purchase, as well as the inventories going up. So if you take a look at the inventories level, it has been going up since July 2021, which you can see the decline of the PMI started somewhere in September. So during COVID time, and there was a supply shortage back then, and some of the business couldn't get goods in the store for people to buy. So that causes the business to double down their orders from the manufacturers, and as a result, the inventories have been building up since then. And there were also inventories building up at home, which causes the consumers to buy less from the store. As if you remember back then, you see people holding up like toilet paper. I mean, this kind of toilet paper here will probably last him 2 to 3 years. So the PMI index is dropping, and I suspect there are inventories built up in businesses at home. And that is reflected in the GDP as it fell 1.4%. So as GDP declined, we do sense some sort of a recession is coming. And then if we take a look at the inverted yield curve between the 2 and 10-year bond yield, I've mentioned this long ago in some of my videos like 2-3 months ago. Whenever we hit 0 or under it, recession period will come soon after. And on average, this is about a year time before recession comes. And we have officially hit below 0 back in early April. So the overall economic data, we still see some signals of recession and a slowdown. And last, we have unemployment rate. So unemployment rate has been dropping down and currently it is sitting at 3.6%. So this low unemployment rate percent seems to be a good data. But I was watching one of the newest ARC video on May 6th. So as mentioned, some business might be holding labor force, similar to consumers who have been holding out inventory goods. As there are a worker shortage in the market right now, so although some businesses' margin has been falling and their business growth is slowing down, they are holding labor in fear of if their company gets better, they wouldn't have the people to help them expand the business. So once the business and the market stabilizes, some of the employees might see they have too many employees at that moment, so they might let some of them go, and that will cause the unemployment rates to go up again. So that is a theory by Kathy Wood, but that sort of makes sense to me, so I'm sort of seeing it that way also. So for unemployment rate, currently we're at a low level, but if the holding of labor is true, then we might see it going back up in the near future. Now, I know everything that I've said so far based on inflation, economic data, and the unemployment rate all sounds very bearish and all seems to be like we're heading into stagflation right now. However, in some of my past videos, I don't think we're in the recession period yet. And I've also seen some people starting to compare the 2008 financial crisis to right now, and right now we're in the middle of a job. We will see a further downside from now, but I don't think we're quite there yet. But don't get me wrong, I'm not saying we will see another 5-10 years of bull run. I don't think that will happen, but I think we have one final bull run before we see the recession, and that final bull run will possibly hit back the all-time high or even higher, and that will trap everybody. And here is why. Since the beginning of November, when the CPI data is going higher, people are afraid of a high inflation rate, which causes the Fed to raise the interest rates. So the market has been falling down, pricing in the rate hike. And the FOMC meeting last week, everybody was expecting a 75 basis point, but the Fed only raised 50. Although that didn't create the rally that I was looking for, because the day after, the scenario of stagflation starting to show up on the media, and the CPI data will be released on May 11th. And as mentioned, based on the data, the CPI data will most likely to be come back down a little bit, and that will create better market sentiment. And if the next CPI data releasing just before the FOMC meeting in June, and if that one also comes down by a little bit, then the June FOMC meeting will possibly make the Fed sound more dovish, and they might not even raise 50 basis points. If they decide to raise 25 basis points, that will set a whole different market sentiment than what we have right now. And the reason too will be the market sentiment. So currently we're at a very low market sentiment at this moment, and in comparison, every time when we got to this low level, it corresponded to some sort of a market bottom in the S&P 500. And the only time that got lower is the 2008 financial crisis. But if we were to set a bar to the same levels, then on this level, we would be somewhere in here. And that's zooming to the S&P in this area. So this little body here will be the body coming from here to over here. And that is a 16% increase, and it lasted from March to May. So statistically, we have 1, 2, 3, 4, 5, 6. 6 out of 7 times that we're possibly at some sort of a market bottom. And 1 out of 7 times that we will see a bull trap. But even in that bull trap, we will see a 15% rally in the market. And that rally will go for 2 months time. And the final data that I want to show you guys is the PMI index and the rate hike. So what I have highlighted in blue is when the Fed is beginning the tightening, when the rate hike is beginning to go up. Every time when it starts to go up, the PMI is at the top ratio. And as you can see, every time when the Fed is starting to tighten, the PMI or the economy is at the top. So they're trying to cool down the economy before it gets too high. And what I have highlighted in red is when the Fed is starting to decrease the interest rate. And as you can see, almost every time when it started to decrease, it corresponded to a bottom of the PMI. So in recent years, you can see the PMI even topping the 2017 high, and the Fed has not even done the rate hikes yet. And the PMI is starting to drop already. So if they were to increase the rate hikes aggressively, they are going to cause a huge drop in the market. So in a way, you can say that they already missed their chance to cool down the market. So that's why you can see the high inflation rate right now. And any aggressive rate hikes will cause the market to plummet severely. So I see this as they missed their chance to cool down the market. And currently we're already heading into recession territory. And with the inflation coming down, I don't think the Fed will be as aggressive as they sound last month, or as the media mentioned, the 7 or 8 times rate hike. So these are the reason why I do think a recession is coming, but it's most likely not going to be this year. And unless there is another global issue that emerge, I'm quite convinced that we'll see another bull run in the coming months before the true recession will come. So this is all I wanted to share today. If you liked the video, do hit the subscribe button and give me a thumbs up, and I'll see you guys next time.